SUERF, the European Money and Finance Forum, bringing together policymakers, finance, and academia.
Welcome to this SUERF-BAFFI Bocconi e-lecture on why are central banks reporting losses and does it matter? Over the past 15 years or so, central banks have used their balance sheets massively to support macroeconomic and financial stability and to prevent inflation from falling below target, as lower official short-term interest rates provided insufficient policy space. Notably, central banks have purchased large amounts of low-yield, long-duration fixed income bonds. As policy rates are being hiked sharply to fight high inflation in the post-COVID geopolitical conflict era, several central banks have started to incur sizable losses. These losses may persist and even increase over coming years. Now, several questions arise. Are such losses a threat to central banks' financial independence and the credibility of their commitment to bringing inflation back down to target? Is insolvency a concern or not a concern for central banks? How could large and persistent losses be addressed in accounting terms? Will taxpayers' money have to be injected? Or will central banks just not transfer seigniorage income to governments for years to come? How should central banks communicate with the public to preserve their credibility under these circumstances? We have a formidable group of speakers to shed light on these questions. Sarah Bell, Head of Central Banking Studies at the Bank for International Settlements, will set the stage and provide us an overview of the topic based on her recent study published in the BIS Bulletin No. 68 from February 2023. A warm welcome to you, Sarah. Then Ulrich Bindseil, Director General, Market Infrastructure and Payments Division of the ECB and SUERF Fellow, will bring in a historical view and embed our discussion into a broader perspective on the relationship of the central bank and its balance sheet vis-à-vis the state. Third, Patricia Mosser, Director of the Program for Economic Policy Management at Columbia University and SUERF Fellow, will contribute a US perspective. A warm welcome to you, Patricia, and thank you so much for coming despite of your health problems. And finally, we hope that meanwhile, Peter Wierts has managed to join us. Peter Wierts is Senior Policy Advisor in the Payments and Markets Infrastructures Division of the Nederlandsche Bank. He will round off the topic with a historical view based on a recent DNB Working Paper from January 2023 on the Bank of Amsterdam and the limits of fiat money. Now, without further delay, Sarah, may I invite you to give your presentation?
Thank you so much for the invitation to be with you all today and for assembling this excellent group of discussants. And I'd also like to just thank the co-authors on the bulletin that you mentioned, who also work here at the BIS and Bank of Canada. So it's a very important and timely topic. And of course, there have been plenty of recent headlines on this topic, usually in the form of, central bank X is reporting an annual loss of Y, and it's the biggest loss in 2 decades or a century, or the biggest ever, depending on the central bank. And more recently, even headlines comparing, for the Fed, for example, balance sheet to Silicon Valley banks. So I hope that today we can sort of get behind the headlines to understand what's driving those losses, what they mean for central banks and for the economy. So to get at this first question of why are central banks reporting losses, I'd like to explain in the context of 2 different types of central banks. So the first type are advanced economy central banks that purchase mostly domestic currency assets or through other programs and are now facing valuation declines on those assets and facing rising funding costs. So this category is a relatively newer phenomenon and is the focus of our bulletin and my remarks today. There's plenty of central banks that fall into this category that you've no doubt read about: Bank of England's asset purchase facility, the Fed, Reserve Bank of Australia, New Zealand, Sweden, Denmark, and ECB, and a number of the national central banks. But there's also a second type of central bank that has built up foreign exchange reserves. These are generally emerging market or small open economy central banks. And there's a long history of these central banks experiencing more profit volatility, losses, and even negative equity. For these central banks, the share of foreign exchange assets went up quite significantly over the past couple of decades, from about 60% to 85% of their assets, meaning that they're far more sensitive to exchange rate swings. And this is the primary driver of their profit volatility through the impact on asset valuations. Because they, of course, report in domestic currency. So current examples of these central banks that are facing losses are the Czech National Bank and the Swiss National Bank. But again, our focus will be on the first category. So what's happening in these advanced economy cases, this first type, as I mentioned? Well, first, after the great financial crisis, these central banks used asset purchase programs or other lending programs to pursue their macroeconomic and financial stability objectives. Other central banks only introduced these programs during the pandemic, but overall, the result has been significant balance sheet expansion over this period. And the use of the balance sheet is essentially transferring financial risk to the central bank and is consistent with the very purpose of central banks. But to fund that expansion, the amount of interest-bearing commercial bank reserves increased as well, reducing the overall share of interest-free liabilities, typically cash and equity. And this funding, of course, was quite inexpensive when interest rates remain low. But here on the next slide, we see that as inflation spiked with the recovery from the pandemic, central banks raised interest rates to tackle inflation, meaning that their interest expenses increased significantly and net interest income declined overall. Asset valuations also declined with rising bond yields, and this resulted in either unrealized or realized declines in profitability depending on the accounting treatment, which I'll get into a bit more later. So the second question, which is perhaps more difficult, is whether losses matter for central banks or more generally. And the answer is really that, except in very extreme circumstances, which depend more on the institutional context than the quantity of losses, they don't really matter for central banks to do their job, meaning there's no impact on central bank policy capacity. Central banks are still definitely able to achieve their price and financial stability mandates. Central banks exist for these policy aims and not to make profits. Profitability is even orthogonal to policy success, since a central bank can be profitable and fail on its policy aims and vice versa. But of course, people can and should debate whether central banks have fulfilled their policy mandates. That's absolutely appropriate. But profitability itself should not really be part of that assessment. And that's because even though we have this knee-jerk reaction to think of, what would happen in a commercial bank facing the same situation, we get back to this headline comparing central banks to SVB. Central banks themselves are not comparable to commercial banks. They differ in their inherent purpose and their structure. They're not profit maximizing institutions. Banks, of course, like any private business, must be profitable, and their profitability matters for financial stability, and we've seen that in recent days. Whereas central banks act in the public good, and sometimes their financial stability goals require them to forego profitability as they act as risk absorbers. They're public institutions. They remit their excess profits to the fiscal authority, and so we can think of them as part of the consolidated public finance picture. And they can't be insolvent in the way that private banks can. In theory, they can always print new money subject to policy constraints. They have a future income stream to recover losses over time. This seigniorage traditionally provides a reliable but relatively limited income stream. It's the net income earned on assets funded through currency issuance, which of course is a non-interest bearing liability, and it provides a sort of structural income stream that's unique to central banks. And they have fiscal backing. They're protected from bankruptcy. And this is a key point when we talk later about the Bank of Amsterdam example from long ago, which did not have fiscal backing as modern central banks do. Banks, of course, are required to have regulatory capital to absorb losses, but capital and more broadly financial risk management is conceptually different when applied to a central bank. Central banks, of course, over history have operated successfully without capital. Some are even required not to hold on to capital, and we've seen several examples over time where central banks have had negative equity for extended periods without compromising their policy mandates. Frequently cited examples are Chile, Czech Republic, Israel, Mexico, but we've looked over the past 20 years and see that about a third of EM or small open economy central banks have had experiences of negative equity without an impact on their mandates. So what happens when a central bank faces losses? I think to understand this, we have to understand a little bit about how central bank finances do work as distinct from banks. And central banks have, similar basic structures in their balance sheet, but their asset and liability structures vary, and there are very different approaches to accounting, to income recognition and distribution rules, and also to risk transfer arrangements with governments, resulting in very different financial frameworks that can affect the timing, size, and volatility of reported P&L. So starting briefly with the accounting approaches, there are three main ones that are shown here, affecting how underlying financial results get translated into reported financial results. So first, fair value or mark to market has the effect of front-loading valuation changes. RBA is an example of this. Others take a sort of asymmetric approach where declines in asset values are front-loaded, but unrealized gains are recognized only in revaluation accounts. And then others still use historic cost accounting or amortized cost accounting and don't recognize valuation gains or losses in reported income, though some do report this for transparency. And of course, if assets are sold, then losses or gains are recognized then. And it's important to note that for central banks, they may apply different approaches even to different portfolios. But the differences primarily affect the timing of income recognition, and results are similar over the long term. So there's no one that's worse or better, but it does mean that results can be difficult to compare along with the different financial year calendars. So next, a word on income recognition and distribution rules. And here we also have a large variety among central banks, where some have to automatically transfer excess profits to the fiscal authority, like the Fed. Others hold buffers to absorb losses. These can be either statutory or at the discretion of the central bank. And others incorporate averaging or distribution smoothing mechanisms to reduce the volatility of transfers to the fiscal authority. So this is a bit of a simplified typology here, but there's many variations and sub-variations, some buffers as a fixed threshold or percentage of profit, different parameters. And frankly, there's almost as many variations in these approaches as there are central banks when you get into the details. But broadly, I think we can identify some pros and cons of equity buffers and capital. The advantage is it reduces swings in remittances to the fiscal authority and therefore reduces the frequency of potential negotiation with the fiscal authority to make sure that central banks are unconstrained by the impact on the central bank to focus on policy objectives. Disadvantages are that the amount that would be needed to cover risks under all possible circumstances would be large and difficult to quantify, but it could be more socially efficient than to utilize that capital for other purposes, given the central banks have inherent fiscal backing. We also have seen cases over time where having capital set aside in the good times can tempt extraction from governments. Again, there's no best approach, and these mechanisms are also not mutually exclusive. And then on risk transfer arrangements. So some governments may provide indemnities to central banks, either for a specific vehicle, like the asset purchase facility of the Bank of England, or specific operations that are segmented. The advantage of these kind of arrangements is that they can make clear that the financial risk of such policy measures belongs broadly to the public sector, not only to the central bank, reflecting those ties that I mentioned earlier. It can be seen as a way to make clear that the fiscal backing, the fiscal support is there. But on the other hand, some see the indemnities as unnecessary since that link is there inherently, and that indemnities may create other risks if they give the impression that the central bank independence may be compromised. So there is an impact on government revenues from losses, and that's true for all central banks who remit excess profits to the fiscal authority. But it is important to look at those transfers, I think, over the longer horizon. So we saw that in the context of low inflation and low interest rates, bond purchases tended to boost central bank income over the last decade. These are just 4 examples, each having, very unique aspects. So RBA in Australia only introduced bond purchase program measures in March of 2020 with the pandemic. The Riksbank transferred an extra dividend in 2000. But we can see that for the US and the UK, transfers were exceptionally large in that inter-crisis period. That's the medium blue color in the middle. And so these transfers will be curtailed for years to come, and that will have an impact on government revenues. But the contribution of central banks to government revenues is relatively modest. And here we show average annual transfers for those central banks on the left-hand panel. And on the right-hand panel, we show for a group of 27 central banks transfers as a share of government revenue. And I think this underscores the point that central bank's purpose is not profitability, is not to transfer profit to the government. They have, because of their structural setup, they have seigniorage income as a side effect of banknote issuance. And one thing to note, I think, in the long term is that this unique currency issuance role means that generally future income would exceed the present negative equity, and that's the case now. But in the future, if seigniorage income is massively eroded, for example, by reduced usage of cash, central bank financial resources for operating expenses may need to be reconsidered in order to preserve policy capacity as well. So when would central bank losses matter? What would the cases be, these extreme cases that I mentioned earlier? I think, we've established that in the vast majority of cases, these losses don't matter for central banks to achieve policy aims, that they matter a little for government revenues. But in extreme cases, in the context of bigger problems, and we list a few examples here, they can matter quite a lot. So the first case, the relationship with the fiscal authority is quite critical. Central bank credibility can erode, of course, if the government exerts pressure on how the central bank pursues its mandates in exchange for recapitalization, which would jeopardize central bank independence. So the more automatic recapitalization arrangements are where they're needed, the less likely this is to be the case. Fully automated rules of recapitalization or rules for how capital would be rebuilt or negative equity sort of back to positive from future income streams would take the uncertainty out of the equation. And when there is uncertainty, then we get into the second case of the risk that misperceptions themselves can create the reality if public and stakeholders misunderstand the reasons for losses and what the impact would be on the central bank, which is why it's so important for central banks to communicate clearly on this issue and have a framework that's well understood for distribution rules and processes for dealing with losses. So reputational risk is serious, and it's best for central banks to communicate about risk at the time when they initiate such programs as asset purchases and when losses may be imminent. And in the third case, and this is perhaps the most extreme case, central bank credibility can erode if the state's credibility is deteriorating, if fiscal backing is uncertain, and macroeconomic prospects are very bad. And here there's a parallel, I think, to the Bank of Amsterdam case where there was the backdrop of lack of fiscal backing and lack of future income stream as well. So just in conclusion, to wrap up, central banks fulfill a critical policy purpose. That's really their raison d'etre, and sometimes it coincides with profitability, as it has for most of the past decade, but this shouldn't be taken for granted. And losses do mean that central banks, do not mean rather that central banks or their policies are unsound or that their policy capacity is compromised. But financial risks are embedded when central banks expand their balance sheets to achieve price and financial stability aims in extreme circumstances. Again, we should be debating whether policy choices were optimal, and with the benefit of hindsight, there can be differing views on that. Inside and outside of the central bank, lessons will absolutely be learned for how to do things better in the future. But right now, central banks are facing tremendous challenges in their efforts to achieve price and financial stability mandates. That has to be the focus, and their profits and losses shouldn't usurp or distract from those goals. So I'll stop there and turn over to the discussants.
Thank you very much, Sarah, for this excellent introduction and overview of the subject. I think one of the core elements of your PowerPoint is everything you need to know about central bank accounting for profits and losses. I've never seen as good an overview as this. Thank you so much for this. I now hand over to Ulrich Bindseil for a historical and broader perspective.
Thank you, Ernest. So, of course, many things that Sarah said, I can only agree. It was a very comprehensive and good presentation. So you indeed asked me, to also cover a historical perspective. So I do it in a very narrow sense. I go back to two very early examples of public bank charters, and just a quote from their mandates. And what one can see is that there was a reference already in the earliest days of public bank creation to profit distribution. Here, this is the oldest public bank charter of Germany, a bank to be created in Nuremberg, which apparently was never really operating, but it's the first imperial charter of a public bank in Germany, and it already refers to the excess income above cost, which could be shared with the city of Nuremberg. And the second quick example, and here comes a bridge to the Bank of Amsterdam, when Palmstorch went to Stockholm to convince there the king of establishing Stockholm Banco, which was the origin, one could say, at the end of the Riksbank. There he also praised, he tried to convince the king to establish this central bank, if you want to call it this way, and there referred to Amsterdam and praised the fact that there are significant profits which remain after paying the employees in Amsterdam that go to the benefit of the city. So in both those quotations, we have a bit the perspective of the hope that there is profit generation by a central bank. And of course, central banks should be structurally profitable indeed, because they have a privilege. The Nuremberg Bank had a privilege. It was the only then to be licensed bank, and Amsterdam, the Bank of Amsterdam, was a real central bank in the sense of issuing means of payment at zero remuneration, while the asset side could be partially remunerated. And then now I have a few points what makes central banks special, and this really overlaps with Sarah, so I can be very short there. So again, as mentioned by Sarah, they are structurally profitable because of the privilege and monopoly to issue legal tender. Second, and there I would maybe go a bit different from what Sarah was saying. The balance sheet structure is no indicator of their default probability, as anyway central banks can't default, and that holds for modern central banks in the paper standard, which don't promise anything on convertibility, like the US Fed or most of the central banks of major currency areas don't give any convertibility promise. Therefore, they cannot default, and therefore they also have this credit risk of zero associated to them that nobody else can have, not even a government. And that is, I think, essential. So fiscal backing for me is not as relevant as Sarah, you put it. The big difference is, do you give a convertibility promise or not? If you don't give any, then you can't default, and therefore you have always credibility of not of paying back your liabilities, and that also gives you all the flexibility to act as lender of last resort. You don't have liquidity constraints. You can always issue the means of payment, and that I would say matters 10 times more than having a fiscal backing. No? But of course it doesn't hold if you give a convertibility promise, be it in another currency or in gold. And then I think, Sarah, you mentioned this point, one should also think of the central bank balance sheet as being part of the consolidated state balance sheet. I mean, one should take both perspectives. One should assume that central banks are standalone entities, but one should then also assume alternatively that they are part of the consolidated state balance sheet, and one should, let's say, discuss losses and risk-taking under both scenarios, under both assumptions, and compare it and draw conclusions only on the basis of having looked at those two perspectives. And last but not least, of course, they have clear policy mandates and no profit target. But here I would also want to qualify a bit what, Sarah, you have been saying. I mean, you have not mentioned that there could be a trade-off sometimes, and you have not mentioned the question of being on the efficient frontier or not. So there must be trade-offs at some stage, you know, because reaching the policy objectives, you can do it extremely aggressively, you know, try to not deviate for a moment from your policy objectives, and that would require you to take, you know, extreme measures, no? And those extreme measures are likely to lead to higher losses. So obviously you have a trade-off, no? And I think one should acknowledge this trade-off. And second, you may not be on the efficient frontier, no? You may take measures which can cause losses, and you could take other, you know, excessive losses, and you could have taken other measures which could have brought you to the same degree of policy achievement with less risks and less losses eventually, no? So there's the two dimensions of the efficient frontier problem, to be on the efficient frontier and to then choose a point in the trade-off is not completely to be denied, no? So that's a qualification on the policy mandate, but one cannot just say there's a policy mandate, so, you know, forget the question about losses, but there are trade-offs, and you can also miss the efficient frontier. And so, okay, probably, I mean, making losses can happen, can be justified, but it is not the normal state of the world for central banks, obviously, because of this natural profitability. Ideally, central banks should know in advance the financial risks they are taking. They should be transparent. They should explain the link between risk-taking, ex ante, losses ex post, and the policy mandate. And all this you said, Sarah, so it's not new to your analysis. And then maybe again, there should be different perspectives now in the analysis. The first one I mentioned already, disaggregate state balance sheet versus aggregate state balance sheet. Both perspectives should be looked at. Accounting versus economic terms of losses and risk taking, and then the short term and the long term. So across those three dimensions, a comprehensive analysis, you know, if then you ask yourself, you know, how can I justify the losses? Have I been on the efficient frontier? Have I chosen the right point there? You know, I think should go into those three dimensions and you know, take the various approaches to be comprehensive. And there can be various cases, you know, where you then your analysis leads you somewhere. Sometimes one, sometimes the other may be more appropriate. But I guess it's good to have those different perspectives. And then finally, I return for a moment to this very old paper, The Role of Central Bank Capital Revisited, which was in 2004. And there, you know, the conclusion was that there are only two real dangers of not returning to profitability in the long run for a central bank. And those are basically the deflationary trap and and if banknote growth slows down too much. Yeah. So in this paper, we did some simulations, and normally central banks, thanks to their structural profitability, they always can recover temporary negative capital and therefore losses. But of course, and it's not very tricky to show that if you are in a deflationary trap and have forever zero interest rates because you don't get out of it, then of course, I mean, the whole basis of your profitability is gone, because that basis is the spread between your monetary liabilities and your asset remuneration. So the most important is to get out of a deflationary trap. And second, of course, if banknotes don't grow any longer, that's also in the long term then an issue. So two implications in practice. First, one could say that having escaped the risks of a deflationary trap, and that's what happened over the last year, is overall positive from the profitability perspective of central banks. I mean, even if we have temporary losses for 1, 2, 3 years, the good news is we get out of one of those scenarios, which are the real killer of central bank profitability, obviously. So it's now temporarily bad, but structurally we are in a better place in terms of central bank profitability. And second, yeah, CBDC, the big topic always can also be referred to here, because if we go towards a cashless economy, then CBDC is an important, a crucial element of sustaining long-term central bank profitability. Obviously, yeah, again, because the profitability, the 2 points just mean, the profit of a central bank is the multiplication of the unremunerated means of payment issued and the interest rate. So both factors are, of course, then showing up in the implications. Thank you very much, and I stop sharing.
Thank you very much, Ulrich, for this very deep insights that you provided, and also for embedding our discussion in a broader historical perspective. Now, Patricia, what's the view from the other side of the Atlantic?
Thank you. Good afternoon. Good morning, everyone. Let me share here. I am going to focus on the Federal Reserve's version of this, which is getting certainly a lot of discussion in the press and so forth. But let me start by agreeing with a huge amount of what both Sarah and Ulrich said. Central banks are part of the government balance sheet. A central bank like the Federal Reserve has, to use the political science term, delegated authority within the government to basically execute certain policy decisions with a certain amount of, quote, independence. That's always the wrong term. Delegated authority is the right one. But there's absolutely no question, particularly, and it's very stark and very clear in the United States, that ultimately the Fed's balance sheet is part of the fiscal government overall balance sheet. And so that in some ways makes the governance easier. It occasionally makes the optics a little harder, I think. So let me start with a few facts about the United States. Here's the Federal Reserve's income, expenses, and remittances. These are end-of-year numbers for 2021, or these are annual numbers for 2021 and 2022. And you can see the big, huge, important change is the second row, where the Fed's interest expense in 2021 was $6 billion, and it was $102 billion. And so there are your losses. The Fed paid $76 billion in remittances. The Fed pays remittances on a flow basis. Anything that is above and beyond what they need to cover their expenses, they give back to Treasury immediately. And they did that from January and through August, at which point they slipped into negative territory because interest rates had risen on liabilities, had risen so much, and it had a lot of longer term assets. And so for the rest of the year, its net income was only $58 billion over the whole year. So that was broken down in two pieces. First of all, they also had other expenses just to run the place. That's the last row. And finally, as per U.S. practice and longstanding agreement, the Fed took an $18 billion deferred asset. Now that deferred asset it's a bit of a misnomer. It's a negative liability. It's the right way to put it. That's what they owe the Treasury Department after in the future, whenever they start making a profit again. Now, since then, the Fed's deferred asset has really accelerated. This is a picture, I apologize, of the Federal Reserve's other liabilities and accrued dividends, and it's not just that deferred asset, but it includes the deferred asset. So it has a bunch of other dogs and cats, sorry, in the accounting. So it runs, crudely speaking, somewhere between $5 and $10 billion. Here, by the middle of March, it had fallen to $35 billion specifically. If you do the net change, you'll see it's about $40 billion, which is where the deferred asset is. So it went from zero, the deferred asset went from zero last September to $40 billion since then. And it is absolutely going to continue to grow. Now, let me pause and tell you how the U.S. does this from an accounting standpoint. First of all, the Federal Reserve has old-fashioned cost accounting for all of the long-term assets on its domestic portfolio. The only place where it does mark-to-market is foreign exchange. And of course, the U.S. foreign exchange reserves are quite small. And while that certainly can move the Fed's profits around, it's not big enough to have a significant impact, not compared to that. So and the automatic loss coverage, if you like, from the government is built in automatically once this happens. So let's talk about the future a little bit. This is a set of projections from the Federal Reserve board staff of interest income and interest expense going forward over the next few years. Let me pause for a minute and explain what this is. This is based on the FOM. This is, first of all, it is from last summer. So almost certainly the central tendency black line in the middle is an underestimate, because interest rates and the amount of interest rate tightening has been a lot more than what was anticipated last July. So the black lines here in the middle are underestimates. The fans are determined by the actual macroeconomic and interest rate paths of the FOMC members themselves. This takes the survey of economic projections seriously, and then it simulates how over the next few years the balance sheet will evolve, and in particular how the interest income will evolve based on the interest rate projections and the growth projections. And it uses the Federal Reserve's model to do that. What's interesting about this chart is the fact that interest income certainly goes down from 2022 to 2024, and then it begins to recover. What's particularly interesting is what happens to interest expense. The same thing. Interest expense peaks sometime this year in 2023, and then begins to dip down starting in 2024, and in fact makes quite a large drop down starting in 2026. And so why is this happening? Why is this? Because this paints a fairly optimistic picture. The Fed is going to have losses. Here you go. So remittances to the Treasury here, which are the black line, is stuck at zero for 2023, 2024, 2025, but remittances recover in 2026. The deferred asset that the Fed holds on its balance sheet completely similarly peaks in 2026 and then comes down very sharply. So the question is, what is behind this? Why is this a relatively odd? These are big numbers. It's obviously $150 to $200 billion in a deferred asset at its peak. But why is it turn around so abruptly? And there are three reasons for that. The first reason that it turns around fairly abruptly why the Fed losses may be less extreme than some might be guessing. The first is the sheer size of seigniorage. Yet another piece of exorbitant privilege of the US dollar. I compared the numbers of the Fed to a chart that Sarah put up in the very first presentation about how the zero interest liabilities of central banks as a share of their balance sheet had declined, while the interest-bearing part had gone up, while they were doing these massive amounts of asset purchase programs, both in the teens and also during COVID. Despite that, currency, US paper currency, is 28% of liabilities, and it's growing. First of all, it's growing in dollar terms, and it's, as the Fed's balance sheet is shrinking, and it is shrinking slowly, it's going to continue to increase as a share of liabilities. And of course, that's pure seigniorage, because it pays zero, and right now, based on the new assets that are being put on the balance sheet, at least, potentially it's going to have a relatively large, it's highly profitable. The other result driving the charts on the previous page is the preference of the FOMC for a generous reserves regime when the balance sheet has finally been normalized. Maybe the way to put this is they're going to normalize the balance sheet at a generous reserves level. The projections of what the definition, if you like, of generous reserves that the staff has been using in round numbers is about $2.5 trillion in 2026. And thereafter, it's about 7% of US GDP going forward. Let me show you some simulations from the New York Fed staff that show this. These are even older. I apologize at how old these are and how out of date. But on the basic balance sheet size, they're probably not estimates even to this day, since the Fed balance sheet is being rolled off in a very straightforward, simple way. So on the left-hand side here are the staff projections of the domestic securities portfolio of the Federal Reserve. This is New York Fed staff. This is done by the open market desk at the New York Fed. And they peaked last year, obviously, and they've started to shrink. These are year-end numbers, so they peaked at the end of 2021. The top line is Treasury securities, and you can see that they shrink as the Fed just allows securities to roll off. They're not selling, to be very clear. They are only rolling them off. And the mortgage-backed securities, the blue line on the bottom, simply roll off in perpetuity. There are no sales in this picture at all. The right-hand side is the projected reserves balances based on the staff's projection. And what's particularly interesting about this is that, as I said, projected reserve balances effectively hit something like 7% of GDP in 2026. That's $2.5 trillion of reserves. And then they project, then keeping it at 7%. But to keep reserves at 7%, they have to, going back to the left-hand side chart, they have to grow the Treasury portfolio, starting with that, presumably at a much higher interest rate. So the entire, so the Fed's shrinking its balance sheet now, but within 3 years, it is going to start expanding it again slowly, nothing like it did during QE. The other reason that the losses in the short run are being mitigated slightly, as the Fed is rolling off less than half of its Treasury holdings each month. They are in roll-off, but it's not 100%. The remainder of Treasury holdings that they do not roll off are reinvested in the same securities at higher coupons. And so actually the Fed's interest income over the course of the next couple of years is going to continue to grow by a decent amount. It's certainly not going to go up as much as its cost of liabilities. Let me be clear. That's why the deferred asset continues to grow for a couple of years. But there is a limit to how far it can go, in part because of the slow speed at which it is rolling off Treasury securities. Here's a picture just to back that up. These are everything above this bar are treasury securities that are being reinvested in new higher interest rate treasury securities as they go along. So if I'm leaving the impression the Fed's going to have a big balance sheet for a long time, that's probably pretty right. The FOMC has made that fairly clear. The fact that they are going to keep it big and the fact that they are reinvesting a large amount means that they are, and in particular, a lot of the bill reinvestments mean if rates continue to go up, they will go up. The interest rate on those will go up as well, will mitigate to some degree the amount of losses that the Fed faces. I'm going to stop there. I do want to make one note on something that Ulrich said, going back to these pictures about transparency. The Fed, to their credit, has been very transparent. They tell you every week, certainly every month, about what the mark-to-market losses are on their balance sheet. If you want to look at that, it's available in their statements. They use cost accounting, as I said, historic cost accounting. So that is not the official measure of the balance sheet, but if you want to know how much of a hit they've taken on securities, that they will tell you. Right now, by the way, from a mark-to-market standpoint, is these mortgage-backed securities that whose value have by far fallen the most as interest rates have gone up. The second part of transparency I want to say is these projections of the domestic balance sheet, and particularly reserve balances and income and remittances to the treasuries, have been produced by the New York Fed since 2012, excuse me. So every year they publish an incredibly detailed report. This is the example from last April. There will be a new report that comes out next month about the year 2022. And they do a very, very granular analysis of exactly where on the balance sheet, both today and in the future, expenses are going to go. So I want to point out that I think that's absolutely critical. People do not understand the way central banks work very well, frankly. In the general public, politicians don't tend to understand how central banks work very well. And so more transparency to the extent that you can make it understandable seems critically important to me for central banks to be able to fulfill their mandates with and explain to the general public what they're actually doing. So with that, I will stop.
Thank you very much, Trish, for your very clear analysis and assessment. And I think you're not alone in your recommendation of transparency. We now finish up our first round of contributions with Peter Wierts. Peter, what have you found in your study?
Yeah, thanks, Ernest, for the invitation, and also for I really enjoyed the presentations, and also very much the paper by Sarah and co-authors. So in my comments, I want to zoom in on a specific aspect, which is the link between central bank losses and trust in fiat money. So my starting point is something I read in the paper, and I think it was also on the slides, that yes, central banks can, of course, operate with negative equity, but still credibility can be impacted in some circumstances. And that was also on the slides presented by Sarah. I think she called it extreme macroeconomic mismanagement and lack of state credibility. So that raises the question as to what are then the conditions under which credibility of fiat money may be at risk when there are losses or extreme negative shocks. And that's where our paper comes in, because indeed we've studied one extreme case, and it was mentioned already. The default, you can say, of the Bank of Amsterdam. And so my brief summary is based on a joint paper with Wilco Bolt, Joint Frost, and Hyun Shin, and it's out both as a DNB and BIS paper. So this downfall, and as I said, is an extreme case, took place in the 1780s and 1790s, and actually it explains why the Riksbank is generally seen as the oldest central bank, and that's not the Dutch central bank, and Ulrich already referred to that as well. And so it's relevant for this case, I believe, because it was a case of a loss of confidence. The Bank of Amsterdam is generally seen as a predecessor of modern central banks, and it highlights the importance of fiscal support. And yeah, I'll come to that, but that was mentioned already. So let me mention some of the reasons why central banks can operate with negative equity. So they can print their own money, it was said. They have franchise value in a going concern case. But actually this assumes that there is demand for fiat money. And to us in the modern day, that may be completely obvious, but in the old times, that was not always the case. And especially for a central bank that pioneered the use of the merchants could shift back to that form, and that's what they also did. And that's why, by the way, in the Netherlands, the use of banknotes for a very long time did not really take off because people still relied on coins. So what we do in our analysis, we explicitly incorporate the demand side, and I'll try to summarize, as I said, what we find without going into the full historical context or the global games model, because that would really take a separate presentation, and I'm here to discuss it. So I just want to give some additional points for the discussions. But the minimum you need to know about the balance sheet of the Bank of Amsterdam is that it was holding coins, so silver and gold coins, against redeemable liabilities, and that was a settlement asset for wholesale payments by the merchants. So that's the role of central bank money in the wholesale payment system. And over time, that redeemability that was partly abandoned. So that was the introduction of fiat money in 1683, to be exact. And towards the end of the period, before it went down, the Bank of Amsterdam started to provide increasing amounts of loans to the so-called VOC, the East Indian Company, basically as a lender of last resort. So you can see that over time, it took up more and more functions of a modern central bank without, of course, looking like a modern central bank that we know today. And then ultimately, there were enormous losses on those loans, difficult economic situation, and trust evaporated. So as I said, we bring in the demand side, and our focus is then on the portfolio choice of the merchants. So the holders of fiat money, and their demand for fiat money in the model is driven by the usefulness of central bank money as a settlement asset, like today, I would say, but at that time only wholesale, now of course also for retail payments next to wholesale. And there are network effects in the model. So that means that there is a link with economic activity and economic shock. So if there is a very negative economic shock, and that's also what's in the model, then the demand for central bank money falls. And importantly, again, there was an alternative, which is coins. And that was so the switching cost, let's put it like that, the switching costs were much lower than they are in today's system. And that could be actually a variable that we forgot about. So that brings me to the supply side. So given the shifts in demand, the supply rule, the monetary policy rule, so it was a very simple monetary policy, was to stabilize the agio, so the price of fiat money, so bank guilders, in terms of coins, or you can say circulating money. So that implies with a negative shock, a fall in demand for fiat money. And given that for some of the coins, there was still redeemability, but not for all, the Bank of Amsterdam had to do open market transactions. So it needed to sell coins to shrink its balance sheet. And there the key point comes in, because it all then depended on the structure of the balance sheet of the Bank of Amsterdam as to how many coins it had to sell and stabilize the price of the fiat money part of its balance sheet, to put it like that. And as we show more clearly in the model, the amount of coins is negatively affected by, of course, the amount of loans, the losses on those loans, and negative equity. And that means that in the absence of fiscal support, and actually there was insufficient support because the bank was owned by the Commune of Amsterdam, and they mainly used it for revenues. They did some kind of fiscal support, but that was quite limited. That then determined the amount of coins. And at some point, given the loans, the coins was just not enough, and there was a loss of trust, and the merchants shifted to the alternative. So to put it differently, contracting the money stock in those circumstances of selling coins when the price of fiat money is low is more difficult than expanding the money stock. So buying coins when the price of at that time the bank yielder was high. So that brings me then to those conditions. What are the conditions that follow from this model and this specific case? And of course, you should see it in its historical context. So the demand method, the size of the economic shock, the more negative, the less demand, and then network effects can set in. The availability of alternatives, so the switching costs that were much lower than they are today. But of course, we do see new technologies arising that may have an impact on the switching costs also today, even though they would still be, I would think, way higher than at that time, because the switching costs also involve the use of fiat money in retail transactions nowadays. And then, of course, the supply side. So what is basically, as I said already, what is the structure of your balance sheet? How many loans do you have? Are there losses on their loans? How many assets do you have to sell? And last but certainly not least, if there is a gap, whether that will be filled by the fiscal authority. And that's, of course, something that would be important in today's framework. So to wrap up, to conclude, how relevant is this for the current situation? Well, I think that's for all of you and the listeners to determine. It's obviously very different nowadays. We have a way more advanced institutional framework. Monetary policy operates quite differently. It looks now at the general price level, and it's not some kind of exchange rate, because basically there was an exchange rate. But I think still the insights are interesting. And for me personally, I was thinking about it. I would say, yes, losses should be an exception. That was also said by Ulrich. Central banks can operate with negative equity if losses arise. The leeway for doing so is very large, but ultimately there are probably limits. And that brings me actually back to Sarah's slide in the beginning. We don't know where they are exactly. But in any case, there was a proposal, I think 2 years ago, by a large group of authors to write off government debt from the central bank balance sheets. I think that's a bad idea, because it could weaken financial independence, and given the kind of factors I mentioned, may not help trust in fiat money for the holders of fiat money, because would they really understand that? And that brings me to the topic that I think was mentioned probably by everyone so far, so also by me, the importance of transparency, because transparency was very low at the time of the Bank of Amsterdam. Rumors played a big role. So I would like to echo Sarah there. It's very important to explain that central banks are driven by their public policy objectives, and profits and losses are a byproduct of those policies. And last but not least, the case of the Bank of Amsterdam is an extreme case, but it does underlie and thereby underlines a key theme in the literature on the role of fiscal backing and a sound consolidated balance sheet of the government. So stop there. Thank you.
Thank you very much, Peter. I would like to give first Sarah the opportunity to react to some of the comments.
Sure, thank you. I mean, I think the vast majority of what the discussants said, I fully agreed with. I think maybe to go back to Ulrich first, he mentioned the three dimensions, which I thought was a really helpful framing, and I fully agree with. I think what I might add to that, though, is one's assessment of those three dimensions ex ante will be, of course, different than one's assessment of those dimensions ex post. And so I think we also have to factor that in, that, central banks were operating in an extremely high degree of uncertainty. And so, there are reasons why they may have assessed the trade-offs and dimensions differently in the context of that uncertainty than one would with the benefit of hindsight. And so I think there's lessons to be learned then from like where those differences were, what do we know now that we didn't know then that we can keep in mind for the future. And I mean, those are super complex questions, but I think it's just important to keep that in mind. I think I very much, I think, agreed with many of his other comments. And in terms of Tricia's comments, yes, I mean, the Fed case is a very specific one. And it is interesting to me how even within the US, with a central bank that's so widely covered, that there is relatively little understanding of how these things work. And I do think part of it may be the density of information, and there's a role to play, of course, I think more broadly in financial education in the US, but certainly not only the US, so that people can more widely understand, and you don't have this knee-jerk reaction, to loss headlines. I think, yeah, the Bank of Amsterdam case, I agree, very, very interesting, what we can learn from it, and certainly I think applicable to, when we think about stable coins and when we think about the preservation of central bank money and the central role of it. And yeah, as everybody said, I think that element of transparency, and I would add to, clarity and transparency have to go hand in hand, I think, as well. So.
Thank you very much. I have 3 questions. The first one comes back to Ulrich's efficient frontier argument, which I find very interesting, very relevant, very valid. Given this efficient frontier consideration, should central banks take profits and losses into account when, for instance, choosing the instrument mix? That is, for instance, now the sequencing between official interest rate hikes versus quantitative tightening in order to tighten the monetary stance. Then my second question is, several among you emphasized the usefulness of transparency on central banks' balance sheets, profit and losses, and even the outlook. Now, Sarah showed very well that central banks' accounting practices differ vastly at this point in time, making it quite challenging for the public to understand and compare across central banks. So financial education is good, but if you need really to be a super accounting expert in order to master this, then it's difficult for the public to understand. So might harmonization of central bank accounting rules be worth pursuing, not only within the euro area, but also more globally? Should there be minimum standards for central bank transparency with regard to profits and losses and forecasts of profits and losses, for instance, coordinated by the BIS or the IMF, etc.? And my third question links to the current, to developments over the past week, let's say. What does the current period of emerging and potentially spreading instability among banks and financial markets imply for central bank balance sheet and profit and loss accounts? They imply, on the one hand, lower rate expectations and yield curves, but what would be the effect on central banks' asset liability mismatch if inflation stayed high and short-term rates might need to be raised further? Patricia, you look like wanting to start.
Yeah, thank you. So a couple of comments. Not so much on the efficient frontier question, which I think is an interesting one, but probably not my comparative advantage. On the transparency question and whether there should be harmonization in accounting, yikes, we can't get a harmonization in accounting right on anything else. So I'm very dubious that we could do that. What I do think is that it would be helpful if there was a set of broadly agreed upon types of transparency. Well, our accounting system is this, but is cost accounting. I'll edit that. But we're going to give you mark to market too. So just so you can see, if we had to sell an asset, this is how much we'd lose. If you did that, they do that. The MBS portfolio, the Fed, they would take a big hit if they actually sold any MBS. That's a perfectly reasonable disclosure, I think. And so a set of standards about what you disclose under different types of accounting rules, I think could be helpful. I'm not so optimistic that you're going to get international agreement on accounting. That seems a little far-fetched to me. On the current instability with banks, look, there's a real possibility that monetary policy is going to go one way and lender of last resort and liquidity provision is going to go completely the opposite direction over the course of the next few weeks. That's my takeaway on some of this. since inflation is what it is, particularly in the United States, it's not going down anymore. And we do have a certain amount of clearly liquidity needs in certain parts of the banking system. So that makes for an interesting contrast. What are we going to do if the asset side keeps if they keep rolling off assets? Let's take the Fed, but we could pick any of the other big central banks. But they're expanding their lending. Now, the lending in theory is going to be almost a zero-sum game, right? It will create reserves, but it's not going to have a huge impact on profits. So from a profitability standpoint, I think you're probably about square there. Where you're not square is if they have to dramatically increase interest rates while they're doing all the rest of this, much beyond where right now markets are suggesting. Indeed, that has been the problem, or not problem, but that has been the story for the last entire year, particularly for the United States. And if rates have to go much higher, then that deferred asset is just going to be a lot bigger for the Fed, or if you like, the equity for other central banks, the equity that has to be provided back to them by the governments is going to get even bigger. Does it ever get to the stage that Peter was suggesting? I don't think for most of the advanced economies that's the case, unless a macroeconomic policy is really, really poorly done. That is a scenario that worries me, but it's not one that I see as very particularly likely, at least for most of the largest central banks. Anyway, just a few comments.
Thank you, Patricia. Might I switch over to Ulrich?
Yeah, happy to do so. I mean, the efficient frontier, to come back to that one. I mean, you give an interesting example. What would it tell us on now the combined tightening through asset sales and interest rate increases? I mean, let me not answer to this exact question, but if let's say going through this and simulating what impact it has, I mean, if you spot big differences in the long-term profit and loss effect, then maybe, and you can say those combinations, alternative combinations, have the same policy effects, then I think it's possible to consider it. I mean, in this specific example, I have my doubts that it makes such a difference. If you take a long-term perspective and if you consolidate the state balance sheet, then my guess would be that those two are pretty similar in terms of profit effects. But I mean, to illustrate the efficient frontier a bit further, I mean, many central banks also bought corporate bond portfolios as easing measures. And of course, those corporate bond portfolios can be well managed or badly managed from the risk framework perspective. So, if you have a poor risk framework, then you will have higher risk without more monetary policy effects. So, I mean, not being on the efficient frontier is easy, no? If you can find many examples where obviously you're just doing things which don't make sense, no? It's easy to construct that. I mean, and the trade-off, I would say, if you are on the efficient frontier, I mean, you can have extreme examples where it's quite obvious that you take too many risks for a marginal policy improvement. Also, yeah, but I think it's more conceptual. It was just something I was missing in Sarah's approach. If one would write now 1,000 pages PhD thesis on the topic, then I think one should develop this trade-off and efficient frontier. If one, if one writes 15 pages, maybe one can just say policy objectives should prevail. But yeah, yeah, that's all I would answer. Thanks.
I can go now. Oh, sorry. Thanks. Yeah, I'll jump in then. I think on that note, yeah, hopefully there's someone listening who is going to undertake that 1,000-page PhD thesis, and we can all learn a lot. But yes, I would agree, and I think it's a sort of ongoing evaluation of where that efficient frontier is. But I do worry a little bit about a sort of implicit bias that one might sort of unintentionally say that policy outcomes are the same because of concerns about relative profitability. That might not be the case, you know. So I think policy outcomes have to be the primary focus, you know, first and foremost. And in practice, it might be a little more difficult to inject considerations of profitability without those kind of overweighting one way or another. On the harmonization, I think I would agree with Trish, and having worked on Basel Committee standards, I think that would be quite a thing to accomplish. So I don't have any high hopes. But I think that what's most important at the end of the day is transparency within a jurisdiction, so that people understand what their central bank and their fiscal impact would be, and the comparability is somewhat less important maybe across jurisdictions. And in particular, I would note that I think one of the riskiest things that a central bank could do would be to sort of change their approach on one of these facets that I mentioned when they're in a situation where they're facing losses, because that would raise, I think, all sorts of concerns about why they're doing that, what they're trying to hide, and I think that would be highly problematic. So switching horses, midway is not advisable. And if there's some 100-year effort to get at harmonization, that would be fantastic. And certainly the harmonization within the euro area is helpful for comparison purposes and makes sense in terms of needing to be able to have that harmonization. But my hopes beyond that are relatively low. And then I think, on the question of what it would imply for profits and losses, I mean, I think we all would have a very difficult time foreseeing what the interest rate path will look like, and that's only become more difficult with the events of the past week. So I think certainly there is a distinct possibility that rates have to go up further, and that would have a hit to profitability, and all the more reason, I think, for us to have conversations like this, and for central banks to be as transparent as possible about why, reining in inflation is first and foremost, and managing financial stability risks are, all of these things should come before profitability concerns.
Thank you very much, Sarah. Peter, last word.
Oh, thanks. Yes, fortunately, I had a little more time to think about the questions, which are really indeed big issue questions. So I thought I have a comparative advantage in comparing the current backstops to the much smaller backstops at the time of the Bank of Amsterdam. And it starts with the balance sheet of the Bank of Amsterdam. And actually, Ulrich pointed that out also in an email of him to me. And I agree, because at that time, there was partly still redeemability, and that money was gone immediately. So you can compare it to the stablecoin run. So that money was the first that was gone. And then that gave the Bank of Amsterdam less money to shrink its balance sheet. And that's, of course, very different in the current situation already. Then if we go to the public backstop, it was the Commune of Amsterdam with not actually taxing power. So now we have the taxing power of the state. And beyond that, we know from the sovereign debt crisis that there is then also the international. So if that also fails, then there is the international backstop of the IMF and the European Stability Mechanism. So that is quite a difference with the situation in those days.
Thank you very much, Peter. This concludes our SUERF-BAFFI Bocconi lecture on why are central banks reporting losses? Does it matter? Thanks a lot to Sarah, Ulrich, Patricia, and Peter for sharing your really deep insights with us. Thanks to all of you for your interest. Have a nice evening. Bye-bye and take care.
Bye-bye. Thanks.
Thank you.
Thank you.